Tell us why you started this to begin with.
Well, the reason we started it is because we know that every CEO knows that his or her workforce, innovation, trust in the community is really vital to their long-term value creation. But there's no line item for those things. And actually, there's no way to measure them. So we were really fortunate in that Mark Weinberger and EY and a group of 30 CEOs representing $30 trillion of assets under management got together and said, let's find those activities, those metrics that can be measured so that investors can contrast and compare how companies are building value in those areas.
Hey, Mark, every time we either have a guest on the show or the question gets raised, is capitalism broken in America? There's almost a religious response in terms of the feedback that goes on in social media or Twitter or what have you. What do you think about that very question right now?
Well, Andrew, you and I have talked in the past, and a lot of what's driving this is trust. So trust is kind of broken. We've seen it in the Edelman report and other reports that trust in government institutions, business institutions are down. And part of the reason is we focus a lot on financial results, but there's so many other stakeholders involved in business. So whether it's your employees, whether it's your communities, those things are incredibly important. And as Lady Lynn said, we've had no way to really value those or measure those before, so we always fall back on those financials. Right. And I think this effort is really meant to broaden that out. So
the real question, though, is what are the other metrics? So let's talk about what you think the other metrics are and whether the metrics are performance-based, whether ultimately they actually do create more value, because that's always been one of the questions about all of these sort of broader ESG efforts.
It's true. So that's why this was so important, that what Lady Lynn has done and what we've done is pull together a group of market-based participants who, these are investors, they're asset owners, they're asset managers, and they're the corporates. And they all say, this is what we really think, from seeing this for years, we're on the ground, working on corporations and investment, are going to be really important to try and measure. We weren't able to measure them in the past, Andrew, because we didn't have the data and the technology that we do today to be able to capture all the employee responses and unstructured data and look at innovation, R&D, and spending and the like. Now they said, we're going to focus on these 4 areas. And Lady Lynn mentioned them: talent, innovation, societal impact, and governance. We all think, every element of this investment value chain thinks these are important. Now we got to come up with metrics that we could agree on, that we can look at across industry. And that's what this was about, narrowing down the hundreds of metrics out there to several that all these members of the value chain will look at. And they're really good metrics, and you've seen the report.
Hey, Mark, I hate to... Go ahead, Lynn.
Go ahead.
No, go ahead.
No, I was just going to say, there's a lot of data in the academic world creating a correlation between those companies that are more proactive with their workforce, with their supply chain, with their place in the community, and lower cost of capital and higher stock performance. So that data is out there. But the problem is, for the portfolio manager, how do you really measure this? They want something tangible, something comparable. They know the difference. And that's what the Embankment Project for Inclusive Capitalism, which you can read about today in the Wall Street Journal, is trying to address.
But let me ask you this, Lady Lynn, especially when it comes to some of these metrics. There's sort of 2 views about ESG investing at the moment, and I don't know if you want to put the Inclusive Capitalism program into that framework, but there are some investors who say, you know what, I want to look at these issues really more as a risk mitigation approach, meaning I'll look at these other factors just to know if there's going to potentially be a problem down the road, but what I'm really going to look at is the bottom line. But maybe this will help me if I think there's some issues around the edges. There's others who think there's actually a true performance-enhancing element to this. Where do you land on that, both of you?
Yeah, let me start, because obviously we have quarterly financials to look at today, and as we've talked about, everybody looking at those know it's an incomplete measure of the value and risk mitigation of a company. Basically, only less than 20% of the assets of a corporation are on its balance sheet today. Back in the 70s, there was 80, 85%. Intangibles, brand, reputation, human capital, all of those things aren't represented. So what these players are saying, Andrew, is that we have to take those into account, as you point out, to understand future risk mitigation, but also value creation. What these assets really do, are the strategic assets, add more than just looking at historical quarterly earnings and analysis. So that's what this is about. I think it's an imperfect science. It's always going to be, but we have to come up with metrics that we can all agree on, and this is a first shot at that volley.
It's a false choice to say that you're either interested in shareholder value or ESG factors or those factors that create a more inclusive capitalism. That's just, you don't have to choose between those two.
Right.
Those two are intimately connected and related, and what we're trying to do is to give portfolio managers a way to measure those things,
right,
so that they can be more sure of the long-term value that they're creating. It's not a choice.